Plug Power is currently trading at $3.85, showing a significant drop of 20 cents, which is nearly 5% down for the day. And while many retail investors, perhaps checking their positions on the Robinhood app or through their SoFi Invest account, might write this off as just another volatile day for a notoriously choppy stock, that view misses the much larger, more concerning picture. This isn't just noise. This decline is a direct market reaction to the fundamental and persistent pressures squeezing the entire green hydrogen thesis, a reality check that is becoming harder and harder for the market to ignore. The expectation for a long time has been that Plug Power would be a primary beneficiary of a global shift to clean energy. The narrative was compelling, a future powered by hydrogen, with Plug's fuel cells and electrolyzers leading the charge. Investors envisioned it as the next great growth story, a name to sit alongside Tesla stock in a forward-looking portfolio. The reality, however, as reflected in today's price action, is that the path to that hydrogen future is paved with immense capital expenditure, persistent negative cash flow, and a dependency on government policy that can be fickle. The story is beautiful, but the balance sheet tells a tale of struggle. The market is slowly shifting its focus from the long-term potential to the immediate and, quite frankly, alarming financial metrics. The current environment of higher interest rates has put companies with high cash burn rates under a microscope. When capital was effectively free, a company could fund its growth ambitions by issuing debt or selling more stock with relative ease. Now, every dollar of capital is expensive. For a company like Plug Power, which has historically relied on capital markets to fund its operations and expansion, this is a major headwind. The elevated trading volume we're observing today isn't the frenzied buying of a dip. It's a more calculated, orderly distribution of shares. This suggests that larger institutional investors, the ones using sophisticated platforms like interactive brokers trading systems, or executing large block trades through Fidelity brokerage services, are methodically reducing their exposure. They see the writing on the wall. The timeline to profitability keeps getting pushed further out, and the risks are mounting. This is a far cry from the activity we might see in names like Apple stock or Nvidia stock, companies that are defined by their massive free cash flow and pristine balance sheets. Those companies command premium valuations because they have proven business models that generate substantial returns today, not just the promise of them tomorrow. Plug Power operates in a different universe. Its valuation is almost entirely based on future expectations, and with each disappointing quarterly report, faith in those expectations erodes. It's a critical distinction for anyone engaged in self-investing to understand. A great idea does not always translate into a great investment. The operational reality for Plug Power involves a tough razor-and-blade business model. They often place their fuel cell systems, the razors, in customer facilities, like warehouses for forklift fleets, at little to no upfront profit, with the expectation of making high-margin returns over the long term through hydrogen fuel and service contracts, the blades. The problem is that producing green hydrogen at a cost-effective scale is incredibly difficult and capital-intensive, so they are selling the razors cheaply, but are still struggling to produce the blades profitably. This continuous cash outflow is the central problem that the market is finally taking seriously. Many individuals seeking investment help through automated platforms like Schwab Intelligent Portfolios or a SoFi robo-advisor are likely seeing their allocations to these types of high-risk, speculative growth stocks being reduced. The algorithms powering these investing sites are programmed to react to heightened volatility and deteriorating fundamentals, and Plug Power is flashing red on both fronts. Even within thematic clean energy funds, like some of the Fidelity ETFs, portfolio managers are facing difficult questions about holding a position that continues to be a drag on performance. For the average person managing their individual brokerage account, whether through the Fidelity mobile app or another online investing platform, the allure of finding the next big thing can be strong. But Plug's performance serves as a stark reminder of the importance of financial diligence. The promises made by management during earnings calls about future projects and partnerships sound encouraging, but they have yet to translate into a sustainable financial model. The company's negative gross margins on its fuel business are a particularly glaring issue. It is literally spending more to produce and deliver hydrogen than it is making from selling it. That is simply not sustainable. Let's briefly touch on what the company actually is for those less familiar. Plug Power is a key player in the development of hydrogen fuel cell technology. Its primary business involves designing, manufacturing, and selling fuel cell systems for the industrial mobility market. Think of the thousands of forklifts and other material handling vehicles that operate in the distribution centers of major retailers. The grander vision, the one that captured the market's imagination, is to become a vertically integrated green hydrogen company. This means not only providing the fuel cells, but also building the infrastructure to produce and distribute green hydrogen, primarily through electrolysis powered by renewable energy. They want to control the entire ecosystem. It's an ambitious plan, but the execution has been fraught with challenges, from supply chain disruptions to soaring natural gas prices, which impacts hydrogen production costs, and construction delays on their new production plants. The recent going concern warning issued by the company, though later resolved through capital raises, sent a shockwave through the investment community. It was a clear signal that the company's financial situation was more precarious than many had believed. Resolving it required them to sell more stock, which diluted existing shareholders and put further pressure on the share price. Looking ahead, what could change this negative trajectory? The bull case rests on a few critical catalysts. First and foremost, a successful and on-schedule ramp-up of their green hydrogen production facilities in places like Georgia and New York would be significant. If they can start producing hydrogen at scale and drive down the unit cost, it could fundamentally alter their margin profile. Second, the execution of large-scale projects and the conversion of agreements into firm, revenue-generating contracts are essential. The market is tired of announcements. It wants to see income. Third, further government support, whether through subsidies from the Inflation Reduction Act or direct loans from the Department of Energy, could provide a crucial financial bridge. However, these catalysts are fraught with risk. Any further delays, operational mishaps, or cost overruns could be severely punished by the market. The competitive landscape is also heating up, with established industrial giants and other specialized companies all vying for a piece of the hydrogen economy. The risk is that Plug Power continues to burn through cash at an unsustainable rate, forcing more and more dilutive financing rounds until investor appetite is completely exhausted. The path forward is narrow and uncertain. For traders using the interactive brokers platform to analyze technicals, the stock has broken below several key support levels, indicating strong bearish momentum. This brings up a critical question for everyone watching this stock and the broader clean energy sector. Do you believe green hydrogen production costs will fall fast enough for Plug Power to achieve profitability before it has to raise capital again under unfavorable terms? Comment below with your thoughts on whether Plug Power will reach positive operating cash flow by 2026. It's the central question that will likely determine the stock's fate. In summary, the narrative surrounding Plug Power has met a harsh dose of financial reality. The expectation was a smooth ride on a wave of green energy adoption, a simple invest online story. The reality is that building a new energy infrastructure from the ground up is a brutal, cash-intensive undertaking. Today's nearly 5% decline is not an anomaly. It is the market recalibrating its expectations downward, acknowledging the immense operational and financial hurdles that still lie ahead. For those managing their own portfolios, whether through Fidelity Investments or Robinhood Investments, the lesson from Plug Power is a powerful one. A compelling story about the future cannot indefinitely substitute for the cold, hard numbers of the present. The market's patience is not infinite, and right now it is demanding proof, not promises. Understand this concept.